Hello and welcome back to Coffee Infused Crypto. Today I have a very interesting topic to talk about. We are gonna break down the Fed's balance sheet and simplify it to the average Joes and degens we are. So we're gonna simplify things. First, we need to understand what does the balance sheet or the Federal's balance sheet is. How does it impact us, whether you are in crypto, in traditional markets, or just a normal human being living on this planet utilizing the dollar. So don't worry about the terms. First, we're gonna address what it is, and then I'm gonna point out how does it work and how does it impact your investments and on and on. So first, let's start with uh, the key points of the Fed's balance sheet, what it is, what does it do, and then we are gonna jump into how does it affect um, dollars, the dollar, and how does it affect Bitcoin, to be specific in this case. So bear with me, even if you didn't understand some of the things I'm gonna read now. We are gonna address them in a very simplified way. So let's start. Grab your cups of coffee, subscribe, hit the like button, and share this if you find it insightful and helpful. So the Fed balance sheet represents the assets and liabilities of the United States Federal Reserve. The assets of this balance sheet are government securities, mortgage-backed securities, and repo rates, whereas the liabilities are the US dollar, money in reserves, and reverse repos. So those are the assets and those are the liabilities. And this balance sheet is updated on weekly basis. So the quantitative squeezing and quantitative expanding or easing, as you've heard those two terms a lot, like being hawkish, being dovish, quantitative squeezing and easing, are tools to help reduce and increase the Fed's balance sheet respectively. So they either increase the assets or increase the liabilities, and we'll see in simple terms how does this work in a moment. During the recession, the Fed increased balance sheet by buying securities to increase the money supply and create jobs. Then, after its normalcy or during inflation in the economy, it uses the quantitative squeezing or unwinding of the balance sheet by stopping the purchase of securities or letting them mature and eliminate from the balance sheet. All right, so this is the Federal Reserve. This is the balance sheet. Here we have the assets, and here we have the liabilities. And by consider this a rope, and it's like easing and tightening, so they're pulling from one side and then releasing from the other, so they control the market and the inflation on the dollar or recessions by just either adding assets or adding liabilities and dumping assets. So it is used as a tool to facilitate economy or tighten the economy. But how does that work for in a simple way? Like I'm gonna explain this as if we are 5 years old. So this is the balance sheet. All right, so this is how much the balance sheet holds in assets, as we said, 8.734 trillion as of now. So to understand this, we have to go and let's add the dollar index. And this is how the DXY and how strong the dollar is. So imagine the Feds have some money, they have money, and whenever they see like we have banking collapse recently, right? And the bankings were just collapsing and they need the liquidity. So what they were doing earlier to fight inflation, since it was way high, but ever since last year, they started selling off assets, if you see here. So selling of assets, accumulating or sucking the market from liquidity. So they sell assets, collect liquidity, and while they were doing so, if you notice here, the dollar, since it's supply and demand, the dollar was getting stronger since liquidity was being sucked off the markets, right? So they're selling shares, they're selling assets, and they're collecting US dollars, burning them or storing them away, pulling them off of the system, and the dollar was getting stronger. And ever since last week, what they did was they printed or they bought or they spent a lot of money pushed into the economy or into the market to bail out a couple of banks so that they don't collapse. And as you can see, the correlation, when they started buying those shares, so to put them on their balance sheet, thus pushing money into the system, the dollar supply increased and the dollar strength weakened. So this is back to basics of economy, supply and demand. So as the supply of anything circulating in the market increases, it gets devalued more and more. So as they pushed this amount of money into the market, okay, to buy shares, the dollar weakened because the circulating supply increased. So where did that money go? Shareholders, people, as in people who had bank accounts, money pushed into circulation into the economy goes back to the people. So you, as an average Joe, sitting home, get an extra paycheck of easier to get or to get some more extra money. What do? You go to Target, you go to Walmart, you go to go on a shopping spree and start buying something that you want. And in investment, in the investment world, whenever money is easily found in the market, okay, it's being pushed, investors tend to find or accumulate that money and buy. Let's move this a little bit to the downside so that you can see. And then they can start buying risk on assets or other investments in other asset classes. So the more money pushed into the system, the weaker the dollar is, since the more money here is being pushed is the dollar. So the more in circulation, the weaker the dollar gets, the more it is found in the system, the higher the risk on assets or the more the investments in risk on assets work. So that's, in simple terms, everything you need to know about the Federal Reserve sheet. So to recap, the more they put into the federal balance sheet, as I said, the reserve, the federal balance sheet. So to recap, the more they push into the market, the weaker the dollar gets, the higher risk on assets rally. So this is correlated with the Fed's balance sheet. So technically, the higher they accumulate assets, the more incentives. And when they push assets into the market, they push money into the market and they start buying assets, that's when we refer to as they're being dovish. So so as you said, the quantitative easing. So they're kind of supplying liquidity for the market, make it easier to find the dollars to invest or to buy whatever you want with it. So the more they ease, the weaker the dollar gets, which will affect on the inflation. So this is correlated with this. So Bitcoin as a risk on asset is correlated with the reserve whenever they accumulate assets, their balance sheet, and is anti-correlated with the dollar. So we have anti-correlation here. The weaker the dollar is, the stronger Bitcoin is, and this is the reason. So now whenever you see this again on social media, you understand that you can understand that a lot of money was poured into the system, was printed, diluting, to be exact, 35% from the bottom, was printed into the system, diluting your cash reserves. That's why having cash reserves should be a small portion and not everything you own as savings, because the more they do this, as they did here as well during COVID, the less valuable your paper money is. So that's everything for today. I hope this was informative enough for you to understand this chart and how does it relate to general economics and to risk on assets and to the dollar itself. If you found this helpful, please do hit the like button, subscribe, and share this educational video with someone you care for. That's everything for today. Have a safe day and see you tomorrow. Bye bye.